Good morning, everybody. It's a great pleasure to be here at BMA House. Like the rest of you, I didn't expect to be at BMA House until yesterday evening, but it's a great venue. I'm going to talk about the UK economy and the referendum. I should say, of course, good morning to people in Manchester and Dublin as well. The theme I've got is about the UK recovery. Is it built to last? I've called it "Will Something Continue to Turn Up?" because it's a good way of sort of describing the economic outlook. But it's also the title of my most recent book, "Something Will Turn Up." Of course, taken from Charles Dickens and David Copperfield and Mr. Micawber. And at this point, I'm supposed to say, my publishers will say, I should say, available in all good bookshops. But I should say also that I've struggled to find any copies of my books in any bookshops. So don't rush out looking for them. It would be a futile search. Anyway, what I thought I would do is pose three questions, partly on the principle it's always easier to answer questions that you've asked yourself, but I'm sure there'll be tougher ones when the panel session gets going. And the three, as you will know, the recent evidence on the UK economy has been a little bit mixed, and to a certain extent, we do seem to have seen some weakness this year. So the question is whether that shows the recovery is running out of steam, is fading, or whether this is just a temporary phenomenon. The second one is the key question of interest rates. They've been very low for a long time. Are they going to start rising quite soon, or could they even be cut from the present very low level? And the final one, I suppose the question which is on everybody's mind at the moment, will we stay in the EU? So let me take those in turn, beginning with the recovery question. And it was, of course, a terrible start to the year, particularly in financial markets, the worst one that people can remember for some considerable time. I think it was January the 20th with the official declaration of the bear market. I don't think there's an official declarer of bear markets out there, but this was the point when the stock market, the FTSE 100, had fallen by 20%, more than 20% from its previous peak, which was April last year, and it coincided with quite a lot of worries about the economy, the risks about global growth, and so on. George Osborne called this a dangerous cocktail of risks that the UK economy was facing, and the kind of things that he talked about was the slowdown in China, the more general slowdown in emerging markets, what seemed to be at the time a collapse rather than just a fall in oil prices. A lot of talk around that time of the oil price going down to $10 a barrel. Amid this dangerous cocktail at that time was not the one that he emphasizes all the time now, which is the referendum risk, but there were plenty of other things to be concerned about. So it was a pretty shaky start to the year. The question was whether that, jeopardized what has been quite a long recovery so far in the UK. So this is now a relatively mature economic recovery. It began in the middle of 2009. At first it was pretty tentative, then progressively it got stronger, and the strongest year in this recovery cycle was 2014, when the economy grew by nearly 3%, since which time it's been still growing, but not quite as strongly as that. But as you can see, on both measures here, GDP 6 or 7% above its pre-crisis peak, and GDP per head has finally also crept above its pre-crisis peak. So quite a long and mature recovery. And in the past, when we looked at lengths of recoveries and so on, 7 years, which is where we are now, would be deemed to be quite a mature recovery. We don't know exactly how how long recovery should last anymore. The one that preceded this ran from the early 90s until 2008, so that was a 16-year recovery. So the fact it's lasted 7 years doesn't necessarily mean it should be about to fall back, but it's quite a mature recovery, as I say. The very positive thing about the UK economy has been the strength of employment, and the employment rate, and this is the employment rate among 16, 64-year-olds, has never been higher than it is now. It's something like 74.3% of the working age population, which is a pretty remarkable figure when you think these records go back to the early 70s, and since that time we've had many more people staying in education for longer, both at school and in further education and so on. So to get a record employment rate, and also to have, most of the jobs that have been created, certainly in the past 2 or 3 years, have been traditional full-time employee jobs. In the early stages of recovery, you had a lot of self-employment, you had a lot of part-time employment. But the last 2 or 3 years, this has been, as I say, healthy, traditional employee jobs, generally good jobs, generally well-paid jobs. So the labour market has been a great success story for the UK economy and continues to be. However, the counterpart to it is the weakness of productivity. The middle dark blue bar there is what has happened to productivity over the latest 3 years for which we have data, 2012, 2015. We're talking about essentially output per hour. There are various ways of measuring productivity, but extremely weak. I mean, normally you would expect productivity to grow by around about 2% a year. It's barely grown at all over the last few years. Some of that may reflect special sort of post-crisis factors to do with the availability of capital, to do with the fact that the financial services sector was pre-crisis a very strong productivity growth sector, and since the crisis has been a sector in which productivity has been falling. Every business person I talk to says that they are doing enormous things to drive through increases in productivity in their business. And as you can see, for quite a lot of sectors that is indeed the case, but there's also a sort of fairly long tail of weak and falling productivity sectors in the UK economy. So employment strong, productivity weak, that is the two sides of the coin there. And if we look at the balance of the UK recovery, it is extremely dependent on the service sector. So the service sector, which is the line at the top, the orange line, that's had a smaller recession than other bits of the economy. Of course, it's the dominant sector, around about 77% of GDP. Had a smaller recession, has had a steady recovery over the past few years. Whereas if you look at those others, if you look at production, overall industrial production, construction and manufacturing, they have yet to get back to their pre-crisis levels of output. So it's been a struggle. There have been times when we seem to be in the middle of quite a pronounced recovery in the manufacturing sector. And yesterday we had some surprisingly strong figures for manufacturing for a single month, but they were good figures. But overall, those sectors have struggled. The service sector has done pretty well. So this has been very much a service sector recovery. As I said earlier, the economy has slowed recently. And the big question about this is, of course, the extent to which it reflects referendum uncertainties, what are called breferendum or Brexit uncertainties, or whether there's something more fundamental happening. As I say, the strongest year for growth is a couple of years behind us, 2014, and the slowdown this year, suggests something perhaps only half the rate of growth that we saw in 2014. 2014 was around about 3% growth. So far, we seem to be on track for something like 1.5% growth this year. Most forecasters are predicting around about 2% growth. The consensus view is, of course, depending on the referendum, that some degree of normal service will resume after it, and that normal service in this context assumes a Remain vote, and I'll come on to that in a second. And this is a typical projection. This is from the Bank of England. This is one of its famous fan charts. I always say about these that it's a great way of presenting forecasts because you can never be entirely wrong. But you look at the bold green bit in the middle, and that tells us that the bank expects something like 2% growth over the next 2 or 3 years, 2% a year growth over the next 2 or 3 years, which is not as strong as we might hope. You know, it may be as much as we can expect in this with some of the post-crisis hangover still in place, but around about 2% growth, and it looks like a reasonable projection in the context of, as I say, a Remain vote. So you know, the recovery still has 2 or 3 years. At least longer to go, I would say, you know, this is not an untypical forecast for the UK economy. So I think it's too soon to call a halt to this upturn. But I think we should also be aware of, you know, the vulnerabilities that we've got. And one of those vulnerabilities, of course, is the referendum and the danger of a Brexit vote. The other is the current account deficit. And the current account deficit is mainly a function not of what's been happening to the trade balance, but what's been happening on the other side of the account. The investment income in particular has weakened substantially. So, you know, there is a vulnerability there. We still have a budget deficit of around about 4% of GDP. So, you know, it's been a long recovery, quite a long recovery, but still we have a vulnerability on the fiscal side. Excessive reliance both on the service sector and on consumer spending, and that productivity weakness I've referred to. So, you know, even if there is a Remain vote, there are still these issues about the UK economy which are potential sources of weakness and vulnerability. What will the Bank of England do on interest rates in this context? Of course, it's been a long time since we had any change in interest rates. The bank rate was reduced to 0.5% in March 2009. When that was done, you know, every member of the MPC, the Monetary Policy Committee, expected the rates to be rising within about 12 months. 7 years plus on, we're still there. This is not only the lowest bank rate in our history, but it's turning into one of the longest modern periods of unchanged interest rates. And the danger is, of course, that, you know, you leave rates this low for so long that any move becomes magnified in its effect. So what might cause them to raise rates? I think we need to see stronger growth than we've got at the moment. I mean, growth in the first quarter was below this 0.5%. We don't know what's going to happen in the second quarter, but it will be something of a surprise if it's 0.5%. I think they would want to see what economists would call trend growth, which is 0.6%, something like that, before being comfortable about raising interest rates. We're talking about quarterly GDP growth there. Wage growth has been somewhat weak. It's around about 2% or so. I think they would want to see wage growth picking up to 3 or 4%. And of course, inflation. It's very difficult to explain an interest rate rise to the public and to businesses if inflation is close to zero. Inflation is close to zero. And I think they, as I say here, they need to be confident that it's going to get back to 2% or more before they would contemplate raising rates. I don't think that the Bank of England is keen on cutting rates. I don't think it's very reluctant to go into the territory that other central banks have done, which is to have negative interest rates. We've got those from the European Central Bank, the Bank of Japan, Sweden, and so on. And the governor of the Bank of England, Mark Carney, has been very critical of that. So I think it would be highly unlikely that they would go down that path. It is possible, in certain circumstances, including a Brexit vote, that they would cut interest rates from the present 0.5% rate. I don't think that would achieve a great deal. It might compound, the problems for sterling that would occur in those circumstances. But there isn't a lot of conventional ammunition left for a central bank when interest rates are already 0.5%. So, and I think they're reluctant to go down the cutting route, even more reluctant to go down the negative rates route. So when might we see an interest rate rise? As I say, the conditions are just simply not there at the moment. The economic conditions are not there. The political conditions are not there because of the referendum. If you were looking for the possibility of an early rate rise, I think the earliest one could think about would be November this year, and that would be on the assumption that There is a Remain vote. There is a very strong bounce back for the economy, so that first half slowdown becomes a distant memory, and inflation is seen to be picking up. I mean, we've seen, some elements of that are in place in terms of the oil price, which is now around $50 a barrel rather than the $10, which was a threat in January. But I would say it is more likely that this will be another year of no change in interest rates. November is a possibility. 2017 is more likely. And the whole theme that the bank is encouraging us to take up on interest rates is that when interest rate rises come, they'll be very slow, they'll be very small, they'll be very gradual, and the new norm for bank rate will be of the order of 2.5%. That will be the new long-term norm, compared with 5%, which is the average pre-crisis, and 12% if you go back to the 1980s. So, gradualism will be the key to it, and they will move quite cautiously, I think, on this. And I don't think anything is imminent. What about the big question, which is about whether Britain will stay in the EU? The cartoon is from the Times, and that was on the day after Boris Johnson had declared that he would be leading the Leave campaign. And of course, Boris came to prominence as a journalist, anyway, for his spell in Brussels as the correspondent for the Daily Telegraph. And this was one of the stories he popularised, stroke invented, about EU regulations, and so hence the title of the cartoon. When the date of the referendum was set for 2 weeks' time, this was in the aftermath of David Cameron's renegotiation, and I think Downing Street genuinely believed that if the Prime Minister came back from his negotiations and he'd got this series of changes, that would be very influential in the referendum debate. There was polling beforehand which suggested that if the Prime Minister came back, said he got a deal, recommended continued membership on the basis of that deal, then the polling suggested something like 75-25 in favour of remaining in the EU. So I think Downing Street was quite persuaded by that. But of course, the renegotiation and its reception was marred in their view by the fact that most of the Eurosceptical tabloids and some other papers, their response was, "Is that it, Prime Minister?" So it came to be seen as not much of a deal. I think some of it is better than it's been given credit for. There is more there than perhaps meets the eye, but it certainly hasn't made any difference at all to the referendum debate. If it is talked about, it is only talked about in a critical sense. So it wasn't a game changer. I mean, the interesting thing about Britain and the EU, however Eurosceptical we've often seemed, the settled position of UK voters seems to be that we're in the EU and we're staying in the EU and that's it. Now this is from British Social Attitudes. It's a survey that's been conducted for many years, and it tends to suggest two things. One is that Europe is not very high on people's concerns, but also that nobody really seriously contemplated leaving the EU until relatively recently. I mean, you might say until the referendum was called. The referendum was first announced, or the promise to have a referendum was first announced by David Cameron 3 years ago. And until then, I think most people hadn't thought that this was a possibility. And even if you go back, 12 years or so, then there was polling which suggested that a majority of British people favoured membership of the euro, favoured taking sterling into the eurozone, either immediately or when the time was right. So to move from that to a position where we are contemplating leaving the EU is quite a profound change. It's almost as though it's poked a hornet's nest, that people hadn't really thought about this before, but the fact of the referendum has made them think about it. So it has brought forward Eurosceptical views which were maybe there below the surface, but certainly weren't on the surface. So it would break the pattern of what appeared to be a settled UK position. In some ways, the timing of the referendum is very good. That UK consumer confidence is very high. Last year it had its best year in the more than 40 years that this particular survey has been done. So, in comparison with 3 or 4 years ago when UK consumer confidence was very low, and people would be looking around for something to blame, and Europe is a good thing to blame, then it's a good time to hold the referendum. Consumer confidence has slipped back a bit this year, but it's still very high. And also, of course, it's better to have a referendum when the Eurozone and the European economy is growing, rather than, again, 3 or 4 years ago when it was on the brink of, when it was in recession and on the brink of apparent breakup. So the timing in that respect is pretty good. But economics is not everything, and you will know that there are other issues in the referendum debate. And on the economy, I think the consensus when people look for what if we wake up on June the 24th and there is a vote to leave, what will be the effect of that? I think everybody expects a big fall for the pound, and even people who are enthusiastic about leaving accept that there would be a market shock, and that market shock would most likely show itself through the currency markets. There'll be an economic shock, a short-term economic shock. Again, I think that is fairly close to consensus, that the uncertainty effects of leaving the EU would cause both businesses and individuals to postpone spending decisions, and they will have a multiplier effect on other activity and so on. So, lower investment, lower spending, higher unemployment and so on. So the short-term economic shock, I think, is quite likely. And I think it would be a big challenge, as I say, to get anything like the single market, certainly over the 2-year so-called Article 50 period. So what kind of European Economic Area relationship could we negotiate? Would it take a long time? Would it take 10 years and so on? So quite a lot of uncertainty there. And I think most probably, and again this is consensus, there would be lower GDP and living standards over the medium and long term than would otherwise be the case. But as I say, economics is not everything, and there are other issues in the debate. And there is quite a lot of skepticism, maybe healthy skepticism, about the economists and about the economics of this. So, that grieves me to hear that, but, issues like immigration, of course, are also very, very powerful. What's going to happen? I think we will stay in. And it's, there are two reasons I would say that. Even though the polls are very close, one would expect that in company with most other big constitutional decisions, most other referendums on big constitutional decisions, there is a shift back to the status quo in the last 2 weeks or so of the campaign. So, and that may come very late indeed. I mean, it may not come until people are in the polling station, but that, in general, there is a shift back. The other one, of course, is the betting markets, which are, have something like sort of 72 to 28% probability based on betting odds of us remaining in the EU. But I think it could be extremely close. I think it's going to be a very nervous couple of weeks, and we'll be even more nervous if we vote for Brexit afterwards. So, and nobody can be sure. Nobody can be sure that this surge in people registering to vote, the idea that the turnout could be as high as 80%, which is much more than we get in general elections, similar to the Scottish referendum. Nobody knows precisely which way that will go. So anybody who says they know which way the referendum is going is I think, misleading you. So I would say, the one thing in this context is that we should all hang on to our hats, because it is going to be quite a nervous and volatile time for the next couple of weeks, and hope for something will turn up afterwards. Thank you very much indeed, and I'll hand over to Julian. Thank you.